Hello everyone! Welcome back to Financial Freedom, your go-to channel for the best tips and tools to achieve financial independence through smart investing. Today, we're diving into a topic that could potentially save you thousands if not millions of dollars over your investing lifetime. In this video, you'll learn about 12 of the biggest mistakes that almost every investor makes, according to none other than Warren Buffett. By acknowledging these pitfalls, we can all make better, more informed decisions in our financial journeys. So, grab a pen and paper, because you'll want to jot down these invaluable insights. This is the Swedish investor, bringing you the best tips and tools for reaching financial freedom through stock market investing. Let's get started. The first deadly sin of investing is overtrading. Warren Buffett often emphasizes the importance of patience in investing. Overtrading can erode your returns due to transaction costs and taxes, not to mention the stress it brings. I remember my early days as an investor, constantly buying and selling stocks, thinking I was making smart moves. In reality, I was just racking up fees and missing out on long-term gains. The idea here is to let your investments grow over time, allowing compound interest to work its magic. So before you make your next trade, ask yourself, is this really necessary? The second sin is ignoring business fundamentals. Buffett is a firm believer in understanding the businesses you invest in. It's not enough to buy a stock because it's popular or because a friend recommended it. You need to dig into the company's financial health, its competitive advantages, and its management team. I've made this mistake myself, getting caught up in the hype and investing in companies without fully understanding their business models. Needless to say, those investments didn't turn out well. If you can't explain how a company makes money, you probably shouldn't be investing in it. By focusing on business fundamentals, you're more likely to make informed decisions and avoid costly mistakes. It's a bit of homework that pays off in the long run. The third deadly sin is chasing performance. This is a trap that many investors fall into, myself included. It's tempting to invest in the hottest stocks or sectors that have been performing well recently. However, Buffett warns that past performance is not indicative of future results. Just because a stock has been going up, doesn't mean it will continue to do so. I once invested in a tech stock that had skyrocketed in the past year, only to see it plummet shortly after I bought in. Buffett's strategy is to look for undervalued companies with strong fundamentals, rather than chasing the latest trends. Focus on the intrinsic value of the companies you invest in rather than their recent performance. This approach will help you avoid the pitfalls of chasing performance. Chapter 4. The fourth sin is the lack of diversification. While Buffett himself is known for his concentrated bets, he advises most investors to diversify their portfolios to spread out risk. Holding a mix of different asset classes and industries can protect you from the volatility of any single investment. I once made the mistake of putting too much money into one sector, thinking I had found a sure thing. When that sector took a hit, my portfolio suffered greatly. Buffett suggests that for most investors, a low-cost S&P 500 index fund is a great way to achieve diversification. So don't put all your eggs in one basket. Diversify. Chapter 5. The fifth sin is emotional investing. Buffett often says that the stock market is driven by fear and greed, and it's easy to get caught up in these emotions. Making investment decisions based on emotions rather than logic can lead to poor outcomes. I've been there. Selling stocks in a panic during a market downturn, only to see them rebound shortly after. Buffett's advice is to stay calm and stick to your investment plan, even during turbulent times. He suggests having a checklist of criteria for buying and selling stocks, and sticking to it no matter what the market is doing. By keeping your emotions in check and focusing on your long-term goals, you can avoid the pitfalls of emotional investing. Stay the course and don't let fear and greed dictate your actions. Chapter 6. The sixth deadly sin is trying to time the market. Many investors believe they can predict market movements and buy or sell at the perfect time. However, even Buffett, one of the greatest investors of all time, admits that market timing is nearly impossible. Instead, he advocates for a long-term investment strategy. I've tried to time the market before, thinking I could buy low and sell high. More often than not, I ended up buying high and selling low. Time in the market is more important than timing the market, so resist the urge to time the market and stick to your long-term investment plan. Chapter 7. high fees and expenses. The seventh sin is paying high fees and expenses. Buffett is a strong advocate for keeping investment costs low. High fees can eat into your returns and significantly impact your long-term wealth. I've learned this lesson the hard way, investing in high-fee mutual funds that underperform the market. Buffett's advice is to choose low-cost index funds or ETFs that track the market. These funds have lower fees and often outperform actively managed funds over the long term. By minimizing fees, you keep more of your money working for you. Always read the fine print and understand the total cost of your investments. Chapter 8. Following the crowd. The eighth sin is following the crowd. Buffett often warns against herd mentality in investing. Just because everyone else is buying a particular stock doesn't mean it's a good investment. In fact, following the crowd can often lead to buying at the top of the market and selling at the bottom. I've fallen into this trap before, jumping on the bandwagon of popular stocks only to see them crash. Don't be swayed by what others are doing. Focus on the fundamentals and intrinsic value of the companies you're investing in. The best investments are often the ones that go against the crowd. Chapter 9. Ignoring risk management. The ninth deadly sin is ignoring risk management. Buffett is a big proponent of understanding and managing risk in your investments. It's important to assess the potential downside of any investment and have a plan in place to mitigate risk. I've made the mistake of investing without considering the risks, leading to significant losses. Buffett's advice is to always have a margin of safety, a buffer that protects you from unforeseen events. Additionally, diversifying your portfolio can help spread out risk and reduce the impact of any single investment. By prioritizing risk management, you can protect your investments and achieve more stable returns. Chapter 10. The 10th sin is overconfidence. Buffett often warns that overconfidence can lead to poor investment decisions. It's easy to get caught up in your own success and believe that you can't make mistakes. However, the market has a way of humbling even the most experienced investors. I've been guilty of overconfidence, thinking I had all the answers and making risky bets that didn't pay off. Recognize that you don't know everything and seek out diverse perspectives and insights. By staying humble and continuously learning, you can avoid the pitfalls of overconfidence. Chapter 11. The 11th sin is ignoring macroeconomic factors. While it's important to focus on the fundamentals of individual companies, Buffett also advises paying attention to the broader economic environment. Factors such as interest rates, inflation, and economic growth can impact the performance of your investments. I've made the mistake of ignoring macroeconomic factors and focusing solely on company fundamentals, leading to unexpected losses. By keeping an eye on macroeconomic factors and incorporating them into your investment strategy, you can make more informed decisions. The market doesn't operate in a vacuum. It's influenced by a wide range of economic factors. Chapter 12. The 12th and final sin is a lack of patience. Buffett often emphasizes the importance of patience in investing. Building wealth through investing is a long-term process that requires time and discipline. I've been guilty of wanting quick results and getting frustrated when my investments didn't perform as expected. Remember that the stock market can be volatile in the short term, but it has historically provided strong returns over the long term. By staying patient and sticking to your plan, you can achieve your financial goals. Patience is a virtue in investing, and it's one of the most important qualities you can develop. And there you have it. The 12 deadly sins of investing according to Warren Buffett. By recognizing and avoiding these common mistakes, you can significantly improve your investment performance and achieve your financial goals. Remember, investing is a journey, and it's important to learn from your mistakes and continuously improve. If you enjoyed this video, please give it a thumbs up and subscribe to Financial Freedom for more tips and tools to help you reach financial independence. Thank you for watching, and I look forward to seeing you in the next video. Until then, stay patient, stay disciplined, and happy investing.